It's a bet against the economists, right?
If they've got a rate and they're at 2%, why would they sell?
All the banks are ahead of the game.
In my opinion, a huge potential that the variable rates right now could be another % higher in, say, 12 months.
In terms of forecasting 30 years in advance and doing a fixed rate, ludicrous.
While your cost of living is probably going to increase, you can't fix your cost of living, as in fix it like a braid.
Shouldn't the bank pay me then? Would the bank pay me?
Will the bank pay you? Absolutely not.
Welcome back to Money on the Mic podcast, episode 2. So thank you for anyone who listened, watched, and commented last time. We got the natural, we got our first hater, which was pretty cool. But thank you for, thanks for anyone who tuned in. Literally after a week, we got a hater, which is always good. Sometimes the best. Anyway, I'm joined here today, Brodie Gilbert, my business partner, myself. I'm Darren Law. The topic of focus, or the point we're going to go through today heavily, is fixed rates and split lending. Don't tune out straight away. I feel like a lot of people may feel that to be somewhat of a boring topic. However, the impact can be severe, and we're hearing a lot of severe might be a bit bad, but we're hearing a lot of, we're going to ask the question a lot. So in our lending business, in our finance business, we get, this is something, we would get 5-10 times a week. So rolling on from last week's episode, Brodie, I'll steer it straight into you. So fixed lending, what is it? Why are people considering it? And what impact does it have?
Hello, everyone. Thanks for tuning in again, and appreciate all the good comments and everything. We got a few through last night, which is good. Any questions, shoot them through as well. That'd be handy. Gives us things to talk about other than just boring fixed rates, basically. I think maybe we're going to quickly touch on the last week's episode and just any kind of changes. So we talked a lot about oil and how fuel affects the overall economy, property prices, etc. So since then, the fuel excise has been halved for 3 months, comes in today. No joke, even though it's on April 1, it's actually coming in today. How that will affect things, it's hard to say. There's still a supply demand. So $3.25 for a litre of diesel might drop back to $3. It could be $3.25 again in 7 days. Who knows? That's kind of a change. Just thought we'd touch on that. And in addition, or kind of leading on, that's probably why we're talking about the fixed rates this week and touching on a question that we probably hadn't been asked in the last, I'd say 12 to 18 to 24 months, is fixed rates, because of the uncertainty. That's probably the driving factor that we notice with fixed rates is when there's any uncertainty, even on the down sometimes, if there is uncertainty, people do like to know what they're paying, and that's exactly what a fixed rate is, as you know. It's locking in that rate for a certain amount of time, whether that's 1, 2, 5. Some lenders used to do even out to 10, but it's generally up to about 4 or 5 years is where we see any lenders offering those, and that just guarantees your repayments for that exact amount of time. That's pretty much what fixed rates are.
Right, I'm going to jump in there. So if we wind the clock back, COVID times, rates were bottomed out. RBA had them basically at zero, which means lending rates got down, had a 1 in front of it sometimes, especially with fixed rates. I think variable rates probably got right down to 2% from memory. But I do recall locking in a lot of clients on 3, 4, 5-year fixed rates at 1.99. So obviously we're in different markets. Rates now are 5, 6, 7%. How is that different in the sense that, previously rates were at a low point and we were talking about our clients and talking about fixing or splitting their loan and fixing it in? How is that different to now?
Well, I mean, the economy's kind of totally different. The reason the rates were so low then was because the economy needed some stimulation, which we got through COVID quite significantly, as we all know. And so people back then were probably locking in knowing that it was probably not going to get much lower. Like if the RBA is at zero, there was only a few countries that were in the negatives, as in their lending rates were in the negatives. Some people don't quite realise that central banks can have a negative interest rate. There's always a margin. As you said, lending rates never is what the RBA or the central bank is. So I guess a lot of people back then kind of realised, well, they're probably not going to get any lower, even though there's not really a whole lot of movement at the moment in terms of uncertainty. We may as well lock them in at, I think we even saw 1.89 with Bank West at some point for a very short amount of time until they got overwhelmed by it and probably pushed them back to about 2. So that was for a long time, up to 4 years. Like we've had clients only this year roll off 4-year rates on 2s or low 2s, 2.29. So that was kind of the economy then. There wasn't a lot going on, and I guess a lot of people and we kind of realised they're probably not going to go lower. So, that's pretty cheap, pretty cheap debt or pretty cheap lending at the time. You may as well lock it in, know your certainty for 4 years. Those people who did, or we'll touch on split loans as you mentioned, but those people who did really benefited. The difference now is that there is that uncertainty, right? So even though we were seeing rates kind of dropping up until mid last year, and fixed rates did reflect that, there was still some uncertainty because although people thought the rates were over, the media was saying, oh, the rate rises are over, the inflation kind of still wasn't under that, or was only under that 3% for a small amount of time. So there was still some uncertainty, and people are still a bit gun shy from COVID, a little bit of uncertainty, just kind of locking them in on the way down. Now there is massive uncertainty. People are, still, like I said, a bit gun shy to leave their rates variable based on what they've saw how much it increased in COVID. That's probably the difference. Is now they're a lot more aware of what can happen because they've seen it quite recently.
Okay. But if we wind the clock back only 7 or 8, 9 months, the general consensus, the market consensus was that we are going to be cutting rates in 2026. So everyone at that time, I mean, if the forecast looking forward is cutting, and that's sort of every news headline when it comes to interest rates, inflation, all that sort of stuff, we know what has materialised since then. We've had a war, we've had multiple other things that have affected it. But, winding back 7 or 8, 9 months ago, when the consensus is cutting, and people are probably not gambling, but taking that comfort in saying, hey, why would I lock in a fixed rate now? At the time, it was probably high 4s, which seems to be an absolute bargain right now. Why would, I guess we know it's changed, but would you be, if a client come to you right now and said, Brodie, hey, fixed rates, rates are going to go up, should I be fixing? Have I missed the boat? Without having a crystal ball, because like I said, 7, 8, 9 months ago, everyone was talking about rate cuts. So if we were there with the narrative going, hey, fix, probably look like an idiot or probably look like a stupid move. So now when people are coming back and going, hey, the consensus is that the rates are going to increase, should we fix or is it too late? Not be holding to anything. What's your advice?
Yeah. So again, it as everything with every person, it's individual based on your risk profile. But we did lock a couple of clients, a few clients, probably towards the end of last year into some high 4s, 4.79, 4.89. There was a couple of 2-year fixed rates available then, and it's kind of, I mean, you look at it from, I guess, a risk reward, like you do with everything, or a bit of a. You mentioned a punt. It's, I think you mentioned a punt.
It's a bet against the economists, right?
Yeah, and what we were kind of seeing in the market, or being told was we're probably going to get 2, maybe 3 rate cuts, and it's probably going to be over the next 12 to 18 up to 24 months, depending on and when I say the economists, they're generally the head economists from each lender. You've got some RBA economists. So you sort of take a bit of everything and try and work out, like we try and work out as best we can of what we're getting fed, and then we will give that to our clients. And what we kind of saw was people were sitting on about a 5.4 to 5. This is again about an 70 to 80% LVR, loan to value ratio, what your loan is compared to your property. Variable rate of about 5.4 to 5.5, and then there was 2-year fixed rates at 4.7. So that 4.7 to 4.8. So if you go, all right, well, we've got potentially 3 rate cuts coming up, but it's going to take the next 2 years, up to the next 2 years, and when we say a rate cut or a rate increase, it's generally 0.25%, right? It's quite rare, unless there's some sort of, again, uncertainty like in COVID where they cut 0.5%. It's generally 0.25. So 3 rate cuts is 0.75%. So if you're at 5.5% and you're looking at 4.75-ish, there's your 3 rate cuts. Why wait? Why wait to see what's going on when you can lock that in now? You're guaranteed. And then if it does pan out based on what the economist said, well, obviously it hasn't. But if it does, then you're actually in front for that, 18 months to 2-year period because you've paid that lower rate. If it goes further, it's probably going to have to go a fair way further below, another almost 0.75%, which it likely wasn't. And if it doesn't go further, you're winning. So it was kind of like a bet that was worth taking.
Hey guys, Darren here. Money in the Mic is part of Fund. Fund is a team of highly skilled mortgage brokers and finance professionals who are pretty much scattered in every state and territory across Australia. So by all means, if you want to know more information about anything said in the show, or you've got a personal question or anything, please scan the QR code on the screen or go to the show notes and you'll find some more information how you can connect with us. All right, thanks very much, and back to the show. I'd say, okay, but right now, let's just say, so we're recording this April Fool's Day, as we just mentioned, so start of April. Right now, if someone's coming to you and going, okay, now I guess the difference being, and what I sort of alluding to before in terms of the market cycle and the direction, take us back to COVID, we had sort of mid 2s, but we could fix it under 1. The rate now, when we go to fix, generally what we're seeing is that the rates are at the level or higher than what we can get as a variable rate. So previously it was lower with the arrow pointing down, hoping that we're going to go down. Now it's higher with the general consensus that they're going to go higher. So people contemplating fixing, I know it comes down to risk profile. And that's probably the biggest thing that people don't understand. If you are completely risk adverse, you're going to lose sleep at night. You're going to worry about that. You should fix. You really should. Ignore every other sentiment. If you're looking at, if your algorithm, your feed, your whole news cycle is about rates and it literally keeps you up, then the peace of mind for fixing, irrespective of sort of where rates go from now, and giving you that certainty of repayment, is just worth the mental loading that you're going to have, the mental safety. But to tile that back in, fixed rates are generally at the level of variable or higher. So now if people are going, have I missed the boat? Again, we're finance brokers. We're not economists, and we don't seem to pick the. We're not here to forecast the next 12 months. I truly actually believe anyone who says they can predict the next 12 months is full of shit. So I think you can probably accurately look about 2 to 3 months in advance. If the president of the United States wants to drop a missile on someone, it changes the game overnight. So I honestly don't think a longer duration than 2 to 3 months is really achievable when it comes to planning where rates are going. But tile that back in. That's a long-winded way to say rates are pretty, let's call them high relative to what they were 7 or 8 months ago. Fixed rates, all the banks are ahead of the game. They've started increasing fixed rates as a safeguard 6 months ago. So clients now, saying that they want to fix, what are their options? What are the limitations if they do fix? And can they fix all? Do they have to fix all of it, or do they go half, or what are their options?
Yeah, so to to your first question or first kind of talking point, why would they do it now? It works the same on the way up as the way down. So it's certainty, right? So yeah, the fixed rates are higher at the moment than the variable. What we're kind of probably, again, we're not economists, and that's left up to them to guess, as you mentioned. But they're higher. They could potentially get a lot higher, depending on, like you said, if US presidents do certain things, which is, looking increasingly like it potentially might happen sooner rather than later.
So what are
Because
the factors, just quickly run me off, what are the factors that would make them higher?
as in, why are the rates higher now than
No, let's
variable?
just
Why
say,
the fixed rate?
okay, can they go another 1-2%? That'd be
Oh,
catastrophic, I think.
yeah. So, but
What
yeah,
what would have to happen for the rates to go 1 to 2% higher?
yeah. So, I mean, like we touched on last week, if inflation goes up and it keeps increasing, the RBA will go up, and the banks will follow that as well. So, and that could be 1-2%. Like, there's so much uncertainty at the moment in the world that if oil doesn't come down in price, which affects everything, as we touched on last week, inflation will increase and central banks will increase. Australia's the first one, or one of few, to increase their rates, and everyone's kind of saying, "Oh, you're an outlier. Why are you raising the rates before when every other economy in the world's not?" There's potential that all those other economies will, because they're all being affected as well. Like, even Russia, who's got oil, they're being affected by this. So, and America, who had their own oil, they're being affected. So everyone's being affected. That's what could drive the rates up. So there is, in my opinion, a huge potential that the variable rates right now could be another percent higher in, say, 12 months. So, at the moment they're looking at around 5.7, 5.8 ish. Whereas there are still fixed rates today, and some banks are still moving them. Like, I saw a couple of banks move their fixed rates today, 1 and 2 years. But there was fixed rates for 1 year at 5.99 and 6.29 for 2 years. So again, if we're potentially looking down the barrel of another percent in variable, fixing now at 0.25% or even close to 0.5% higher, to know that what that certain repayment is going to be like, especially while your cost of living is probably going to increase. You can't fix your cost of living, as in fix it like a braid. That to me is, again, if you're risk averse, that is a huge control point that you can put in place now. Yeah, it's never really a great feeling to go, "Oh, I'm gonna fix in higher than what I could pay right now." But again, you're sort of hedging that bet that over the next 12 to 24 months, you're actually going to be better off in your pocket, and there is potential for that to happen right
And
now.
bro, splitting a loan. So let's say if I've got a $600,000 mortgage, why would I go, say, 300,000 into a variable rate and 300,000 into a fixed? Why would I do that?
Yeah, so you can spread your risk a bit. So you might go, "All right, I want to fix. I want to know some certainty, but I don't. I'm kind of happy to let the market play out as well." So you can fix anywhere between 10% fixed to 90% variable, and 90% fixed to 10% variable, anywhere in between that. Generally, people go half and half more often than not. And then some people do, depending on like, if they're a bit more risk averse, they might go, 70% fixed and leave the rest. So that's a good way to sort of spread your risk. So you've locked a certain amount in, but you're sort of still letting the market run. The other thing is, if you've got something that we haven't touched on, but I'm sure we'll probably do more on another episode, is offset accounts. So if you've got a lot of money just sitting there, or redraw, however, but if you've got a lot of money sitting there, say for example, 300,000, and you're $300,000 in cash in your bank, and you have a $600,000 loan, you can basically offset that. So that $300,000 can be paid into your loan or sat in an offset to minimise your interest repayments or your interest costs. Whereas, and with a variable rate, you can, generally speaking, offset or, offset 100% of what's in there. Whereas fixed rates are very restrictive. So you asked me before, what are the restrictions on fixed rates? You if you had $100,000 and you dumped it into a fixed rate, I don't even think anymore that you can. Some of them used to have a 15% offset account or something like that. Most of them just don't allow you to offset any fixed now. So all that money kind of goes to waste. So you could have 300,000 fixed. Your repayments. That's what your interest is going to be charged on, and then 300,000 variable. Dump your 300,000 in there, and that's at your disposal. Again, holding cash for uncertainties, but not paying the interest costs for it.
Okay. You said some of them don't allow it, I think. Not to go back on it on this, but there are some banks, there only a very, very small cohort of them, that have a fixed rate with 100% offset account. That's pretty attractive. They usually, to offset that, they usually have a higher fixed rate than what the general market is offering. So if someone comes across that or that sort of unique product where they go, hey, I've got $600,000 mortgage, but I've got $300,000 or $400,000 in cash. I'm actually worried about the rates going up, even though I've got a lot of cash. 100% fixed rate, a fixed rate with 100% offset account seems pretty cool to me. What's your thoughts?
Yeah, there are a couple. Three lenders that I know of just off the top of my head, and I know that there was one that has not was kind of the market leader in that that doesn't offer that anymore. So yeah, out of the 40 odd lenders that we've got, 3 to 4 maybe offer that, which it is good for that. I guess the other thing you see with those lenders is you kind of lack in a bit of functionality on online banking or just general banking. None of the majors offer that.
That's their kind of niche product, isn't it? So that's their draw card. So
exactly.
Like I said, the functionality, other things that they might charge you additional fraud valuations, or they limit, or if there's any changes, they actually charge you an app fee to make any variations. Discharge fees, stuff like that could be increased. But that is kind of their draw card. And look, don't want to throw the net across the whole lending market, but a lot of those lenders sort of offer a very vanilla product in order to have that functionality, having a 100% fixed rate. You touched on 40 lenders. I think I think our panel's nearly non-exhaustive. We can go off panel and kind of look at anyone if we want, within small limitations. But the just on said splitting, you said fixed. All right, if I'm deliberating this and going fixed, split, or splitting my loan, or whatever it's going to be, but I also don't know if I'm going to sell my house. What would your advice be if I'm going to considering selling my house next couple of years? What would your advice be? Would you go to?
Yeah. So you're obviously alluding to break costs. So probably wind back the clock. What 10 years, maybe even longer than that. There used to kind of be break costs across any lending, depending on how much it was. But even like variable lending, there was generally a break cost which got basically ruled out. I can't remember when, but it was over 10 years ago. That if you were on a variable rate, you basically just pay your legal fees, which to discharge your mortgage and whatnot. Say if you sell the house, up to a few $100, maybe $1,000 total in fees. Whereas fixed rates still have break costs applicable, and that is based on obviously the lending, or the bank lends you gives you your money, your loan, based on the cost of their funding. So what they get that money for, because obviously banks don't just all have that money. They get money, as we know, from other wholesale funders, funding warehouses, RBA, all sorts of different areas, and that costs them. So they're kind of locking in, all right, they're going, I'll lend you this amount of money, and it cost me this much. So therefore, if you break that, I'm going to charge you a certain amount. And that can be when they're higher rates, it can be quite significant, especially when the general consensus or the trend of the rate movement is increasing. When it's decreasing, say if you locked in right now at like 6%, and then everything switched around and the rate started going down, well, that is that to a bank, that is they want to keep you kind of locked in at 6%, so they will charge you you know, probably more than if they were to if it was to go to the other way, and you could break and go variable, and the variable was actually 6.5. Although of course they're going to probably go, all right, we'll minimize that break fee, because you will revert onto a higher rate, and therefore we will get more cash. So if you're going to, and when those break costs or those instances where you break your loan come, whether you sell, whether you refinance, whether you pay down the entire loan, that is breaking the contract that you've got with the lender for that amount of time, and there's potential break costs. And I've seen break costs up to 40,000. Like, it also depends on how long they've locked it in for. If you lock it in for 5 years and you're 1 year into it, there's potential that those break costs could be quite large. So that's something that probably goes unknown as much. Like, that's something that we know, and obviously we speak to clients about that, so they know, oh, you know, I want to lock it in, but there's potential I'm going to sell my property in 12 months. Well, let's not lock it in for more than 12 months then, because of this reason.
Yep. So 2 things I just want to touch on there, which I think is really important. And another question I want to throw at you. So break costs, a couple of questions for you to remember. So break costs, if I lock the rate in now, and let's just say that rate is 6.5%. If the RBA completely pivots, the world goes back to normal, improves, all these great things, rates start to come down, and I go, oh, I've locked in for 3, 4, 5 years at a higher rate. I want a lower rate. That's an example where a break cost would obviously be higher. Can you explain to me why? And also on the reverse situation where I've locked in a rate, say at 6.5%. Again, 5-year contract. We're halfway through it. Let's say variable rates are at 8, so they've just gone. RBA's come out. It's gone a couple of percent higher. I've got a lot cheaper rate than what the market can give me now. Would I have a break cost on that loan?
On the way up, more than, it's hard to say, because it's not just a simple, the rates have gone up, therefore the bank's going to make more money. Like, their cost of funding at that high rate is still increased as well. So generally speaking, though, if the rates are quite significantly over, as in the variable rates are like 1% or something higher or beyond that, then your break cost would be probably minimal to none. Because again, you're going to effectively go to the bank and say, hey, I've got 6%, but I actually want to pay you 8%. Well, if I'm a bank, I'm going to go, well, okay, no worries. But, but I've got this fixed rate.
Shouldn't the bank pay me then?
Will the bank pay you?
They're earning money on the contract. Shocking.
No, absolutely not. And then, on the way down, it's kind of the reverse. So, yeah.
All right. So again, just to recap on the question. So on the way down, so if I've locked a higher rate, I go, oh, I've made a mistake. It is it's only a mistake looking backwards, right, in hindsight. But turning around and going to my broker and saying, hey, look, can we go to another bank or get out of this contract? It's going to cost me money, isn't it?
More than likely, and that we can work it out. Say if there's $1,000 break cost, but
when you say we can work it out, so we do have a break cost calculator. I mean, clients can also source that on the internet. It's not something that's privy just to us, but it is, because there's a few factors that go into it: the amount of debt, the duration. Again, the bank will kind of judge the break cost based on what the new fixed rates are at the time you're wanting to break it as well. Right. So is that a tool? Is that something that, if I'm considering fixed rate, if I go to my broker and say, there's a break cost calculator, I heard these 2 blokes talk about it on a podcast, can you go through and give me a couple of examples and scenarios and go, hey, if I fix a portion, if I fix all of it, if I fix this amount, and then just theorize a couple of scenarios, that's something we can do for them.
Yeah, and I mean the source of truth of what your break cost is going to be is obviously us and the current lender, like because there's a lot of variables and they never give us the exact formula of what that break cost is made up of because there are so many factors, but you can kind of get a gauge. So it obviously, again, as we always mention, come and talk to a broker because we can run those scenarios. All right, there's going to be break costs here of you've confirmed it of $1,500, but there's over the next 18 months there's there's $2,000 worth of savings in terms of the difference. So that's where you're like, all right, we'll take the hit. It's you don't want to pay the 1,500 or whatever, or the break cost, but if it's actually putting you in a better position over the short, medium, and longer term, then that's something that we can lay out for sure.
Yep. Probably one other thing, and just sort of to tie it all in, variable rates, your broker or a good broker should go out to the market, go to multiple banks, negotiate, go back, try to get additional discount on the variable rate. And that's obviously a big value add to clients. Fixed rates, can you do that? So if I see a rate sheet at, let's just say Suncorp, can I take that to Bank West and go, hey, can you match this? Does that generally happen, or is that not such a thing?
Yeah, you definitely can. It's not as open slather as the variable rates because that's where they really get the knives out. Fixed rates, you can get a bit more of a discount on what they're offering. Sometimes we see like 0.05 to 0.1% in addition as a discount, so lower, but you definitely can. And it also comes down to a few different things of size of lending and LVR and things like that. So you definitely can, and the brokers have got the tools to do that and kind of get an outcome pretty quickly. Like, as you know, we'll put requests in through each lender's portal, and we'll be able to find out kind of immediately, push that up, speak to our contact at the bank. Will this, if we can shave a bit more off here, the client will be happy. So that's the work the brokers will do behind the scenes. That probably, I guess if you just walked into a branch, they're probably just going to offer you their rate and you just ask for a discount. Well, unless you've gone and done the work for yourself from so-and-so down the road and so-and-so further down the road, then they'd probably just say, look, that's our advertised rate. So not as much as
So on that,
variable, but definitely definitely a little bit.
so on that point, walking into a branch and they, it might seem obvious, but walking into a branch, they can only offer what they've got. So, you can only sell what you've got in your shop. So the difference between that, walking into a broker, touch on best interest, Judy, just quickly when it comes to the additional steps we have to do and comparative to, say, just walking into a branch and getting only what they're going to offer you.
Yeah. So everyone's got their own requirements and objectives. Every client, every customer's got their own requirements and objectives, and we through I think it was probably a bit before COVID. Actually, people may remember there's a Royal Commission in the banking sector, and a lot of it, shockingly, got pushed onto brokers, and all the responsibility got pushed on the brokers to basically always provide products or comparisons in line with the best interests of the client. And generally speaking, that is cost. That's not always the case, but it is cost, and cost is interest. So, which we kind of already did anyway. Like, that's why I became a broker, is because I kind of got annoyed with my own mortgage, and I wanted to go and find other options, and because that was in my best interest. So we kind of were already doing that.
I wouldn't say kind of, we did. But I'd say now we're governed by it. So whether you're a good or bad broker, you are literally governed and stipulated. You have to do best interest of the client, otherwise you're legally liable.
Yeah. So as you know, compliance, like, that is the number one thing that they will look at. And it's actually not that, it's not a hard thing to do. Like, that's what we do. Like you said, that's exactly what we do. This is what, there's nothing better than going to a client and saying, look, I've actually, out of cycle gotten you a better rate. Of course they're going to be happy. They're paying less to the bank. So it's something that is always at the forefront of our mind, and now it's just simply regulated. So whereas or it has been since about 2019. So whereas if you go into, I'm not going to name any lenders, but a branch lender, what can they offer you? That is totally only their product. So therefore, are they working? If you go down the road to another lender and their banks are, or their rates are cheaper, that first lender, they're not going to say, oh, that's actually better for you down the road because it's cheaper. They don't have to do that, whereas we have to.
They don't have to do it, do they? So they're not governed by best interest duty, are they?
Well, they're actually not. Well, to push it in further, they're not even allowed to, because as employees of generally ASX listed companies, their fiduciary duty, their only duty is to increase the value of shareholders. So how do they?
Say fiduciary again.
Fiduciary.
Hey, I just want to. I want to throw a little left field comment here and just get your thoughts. This is general thoughts. You said at the beginning, we have 1 to 5 year fixed rates in Australia is the general norm. We can't do 7 and 10 year rates. Typically, they are higher. America has 30-year rates. Why don't we have 30-year rates? And why do they have 30-year rates?
I actually don't know why they have 30-year rates.
I think it's ludicrous. I don't know. I just said before, I don't think an economist can go further than 3 months in advance. So to pick rates for 30 years, beyond the crystal ball. I mean, they fixed it 2% in 2020, and now they're at 7.5. Oh, no, they're not. They're lowering. But the point being, they were at 7.5 only 12 months ago. So their economy completely went from within 4 years going, hey, it's 2% for 30 years. And if you go buy another house in 2024, 2025, it's 7%. But that 7% will never go down. The 2% will never go up. If you do the mathematics on the total interest and you've paid only your minimum repayments on the house, and you pile that in as the total cost for the property over 30 years, you're talking one property could cost you $1 million. The same property next door, without the price going up, could cost you $2 million because of the interest cost. Those numbers don't. I don't know. I'm speculating. I know that they're fairly broad ranging, but the point being. Yeah, okay. You don't know. Yeah, I think I don't know how they do it. I do know how they do it, but essentially they purchase the money at the time, and that's where they sell it. But in terms of forecasting 30 years in advance and doing a fixed rate, ludicrous. Like, will we ever do it here, or like?
There would be a range of things that would affect. I would imagine. Why, say you've gotten the growth in your property in the last 3 to 4 years, but you're on 2%, that's going to be a significant reason not to sell. So if we look at like people later on, getting close to retirement that have got, those boomers, so to speak, have got bigger houses, they're already hit with stamp duty that they have to pay if they want to downsize. If they've got a rate and they're at 2%, why would they sell? Why would you then sell to go and get a higher rate? Like, it would just, like, our economy.
And it disincentivizes, right? So it disincentivizes movement thereafter. And probably, therefore, maybe that actually, it does, creates other issues in the property market.
Yeah. I don't think, I think America do a lot of things pretty differently. And I'm pretty sure I saw recently that Trump was talking about why not having, was it 100-year loans or something?
Like I've seen at least 50, and I was like, considering the average age in America now for a first-time buyer is just breaching on 41, for a 50-year mortgage term, there'd be 91. So just a fresh 91, just finishing off their mortgage. So, differently is a politically correct way to put it.
Yeah, definitely. I don't think I don't think the lenders, and our banking system's nowhere near as hardcore as theirs in terms of their fractional banking and how that allows them to lend significantly more out as a lender. So I don't know why Australia would ever do that, and I would not want to see that either.
Okay. All right. To tie it all in, so fixed rates, like I said, the economy right now is somewhat scary for a lot of people. If you're thinking about fixing, I would suggest you definitely chat with your mortgage broker. I know that seems like, our parting advice a lot of the times, but do your due diligence, do some research, think about, a few key factors we spoke about. Are you planning to move or sell? Or sell mainly in the next couple of years? If so, then fixed rates, unless it's a short duration fixed rate of 1 or 2 years, they're probably not for you, considering the potential break costs. Beyond that, if you are constantly reading the headlines, if you're constantly being scared, worried, concerned about these raising rates, then fixing a rate or fixing a portion of your rate is probably a good thing to heavily consider. Speak with your broker. Don't shoot him or her if in 12 months the rates go the different way. We're not economists. We are going to we'll put our opinion across. We're going to read the headlines that you're going to read. The difference being that we read them daily, if not, a few times a day to get updated info. So yeah, Brodie, again, thanks for your time.
I think
Anything you
one
want to
more
part?
thing before we do bail is just on the fixed rates, rate lock. So basically, if you do want to lock that rating, because it's subject to change, generally speaking, until settlement, with a caveat of a couple of banks, there is a fee sometimes to lock that rate in. So you
So we say
definitely know
subject to
before
change.
settlement.
If I called you, give me an approval today, and I settle in, I don't know, middle of May, and that my bank is giving me an approval, the rates go up, what happens? If I haven't put a rate lock in, what happens?
They'll be subject to whatever they are that day. So say, for example, these lenders that I saw.
What day? Sorry, what day are you talking about? Approval?
On settlement day, whatever the rates are on that settlement date that you settle that loan, that's what you will get. So if that's 6.2, whereas you got an approval 2 months ago at 6 and you didn't lock the rate, you will have 6.2 applied. So the fixed rate is not fixed and locked in until you settle, unless you pay that rate lock fee. And that's a percentage sometimes, or a flat fee, whether it's 750 or 1,000, or it's 0.1% or 0.15% of the actual fixed loan portion. So it's not against the split, it's just the fixed. So yeah, that's something that is not commonly known, and something that needs to be considered. It is, especially at the moment, it's a conversation piece that, all right, this is what it will cost you, but this is what it may cost you if you don't. Again, that comes down to what risk you want to take.
Yeah, good framing. If I didn't take that risk, if I didn't pay this, $600,000 to rate lock, and it didn't go up, obviously I just saved that money. But if it didn't change at all, do I get that rate lock fee back? Is basically what I was alluding to, or is that no?
No.
So it's just to give you that guarantee after approval up until settlement that the rate won't change.
That's right. It's basically like paying for your fuel.
It's fixing the fix.
It's fixing
Double
the fix.
fixing.
It's paying for your fuel today and knowing what the price is going to be, even though you might fuel up in a month.
Yeah, that's good framing. All right, let's leave it there. Thanks for your time.
Thanks, mate. Like, subscribe, and
do all the things. Comment.
And do all the things.
Yeah, tell us only good things.
That's right.
All right, cheers. See ya.